When markets surge against all odds, defying predictions of a crash, it's not just a fluke. It's part of a pattern. Whether it's the 2020 COVID stock rebound or the post-2008 financial crisis recovery, there are clear signs that always appear before markets bounce back in ways that no one expects. Today, we'll uncover the warning signals that often precede these surprising rebounds and what they mean for the future. This is what happens before a reverse market crash. And in today's video, I'm going to discuss exactly what a reverse market crash, otherwise known as a melt-up, is, why they happen, what this means for the US versus other countries, and how to protect yourself in the aftermath of a reverse market crash. Okay, so let's get into it. Let's discuss what always happens before a reverse market crash. So we need to start by understanding what a reverse market crash is, because we all know what happens during a market crash. Yes, that's right. Everything goes to hell in a handbasket. Assets lose their value, stock markets fall, people lose houses, bad things happen. And quite often, it's not just a part of a recession, but part of a financial crisis, or in some cases, even a depression. And reverse market crashes are also often known as melt-ups. This is when there are sharp rises in asset prices without fundamental support. For example, in 2020, when the pandemic happened, everyone expected that the market would absolutely implode. And for a very short period of time, it did. But then things got better really quickly. And asset values across the board increased. Whether it was your real estate holdings or your stock holdings, things went up in value, and they went up in value quickly. In fact, there were many millionaires made off of things like the whole GameStop fiasco, simply because people had so much money, and so much more money than they expected to have, that all asset values went up in price because, well, there was simply significantly greater demand for pretty much everything. Now, the 2020 fiasco was very much a complete reverse market crash. But that doesn't mean that there aren't reverse market crashes in different sectors of the economy at different times. Think about the tech bubble in the late 1990s. Think about the real estate market that went through the roof in 2006. And think about certain times in history where stocks have inexplicably gone up in value. And in a lot of cases, these are very much surprising circumstances. In fact, they often represent a magic trick, fueled by simply psychological effects in the market. That belief that assets are only going to continue to go up in value, and I have to get in now, because if I don't, I'm going to miss out on a massive opportunity. And this is very much driven by market optimism. And market optimism often leads to irrational exuberance. I mean, just think of what happened during the pandemic when debt got so cheap it was almost free, and everyone went out and YOLO'd on pretty much everything, buying houses, stocks, and everything they could with debt. But as we know, this is often followed by a sharp correction, the kind of correction that hurts the poorest of the poor, and in some cases doesn't really affect the rich of the rich, but definitely creates a widening wealth gap. And there's lots of historical examples of melt-ups. Now, these more commonly are tied to places like Venezuela and Zimbabwe and hyperinflation. And hyperinflation, or even high inflation, is really the primary factor that we need to look at when we're looking at a reverse market crash. And of course, this often comes with cheap or free money. And as interest rates tend to go down, that tends to lead people and companies to borrow, which tends to lead to increases in asset values. But this can also come as a result of countries having weak currencies. Think about 2008 when the US currency definitely lost a lot of its value. And it can also come as a result of fiscal mismanagement. Governments spending way more money than they should be at times when they shouldn't be, leading to more money being available in the market, and subsequently inflation, which not only makes things more expensive, but if you had bought certain types of items, which I'll talk about a little bit later on, it also means that your net worth and the value of those items that you bought previously could have also gone up. And that's one of the key distinctions between those that do well during a melt-up and those who don't. But I'll talk about that a little bit more later. But first, let's talk about why melt-ups happen. There are some key drivers that are always present during a melt-up or a reverse market crash. The first is high levels of money printing by central banks. And this doesn't just mean money printing, it can also mean in general just reductions in interest rates. And as a result, we find ourselves in a situation where there's extreme inflation that drives asset prices higher. And this compounds itself when we have negative real interest rates, because these incentivize investment, but often incentivize investment when it's not sustainable for the long term. And this is very much what happened in 2020 and also in the aftermath of 2008, when interest rates were lower than inflation, which meant pretty much every business and every wealthy person out there was able to borrow money and get excessively high returns as a result, leading to, again, those massive melt-ups in the values of things like stocks and real estate. Now, in addition to this, loose monetary policy is also a major issue. For example, we've had quantitative easing, which has inflated asset prices, and we're still feeling the effects of this today. Then there's stimulus measures, which have distorted economic reality. This is the government injecting money into the economy during times where it's arguably needed, but it also has a significant effect on asset values. And again, during these times, this is when the rich get richer and the poor again get poorer. And then that leads to things like artificial growth that's not backed by the fundamentals. Take a look at what's happening in the gold market right now, with gold hitting all-time highs. But that gold buying frenzy is largely driven by two things. The first is fear, which by the way always dissipates after a year or two and usually leads to a correction in the gold market. And the second is the irrational beliefs that lead people to stick all of their money into different types of investments long after the opportunity has since passed. And we've seen this over and over again. We see this in the psychology of the stock market, where forward-looking beliefs don't represent what's actually happening in the present. And this is often why people who make short-term bets in the stock market often lose, while people who stay in the market for a long period of time typically win. It's because those people who start making the short-term bets tend to not be focused on what is actually happening and think that there's significantly more opportunity for growth than there is. And this is particularly true when interest rates are coming down and people start to see light on the horizon that may not in fact actually be there. And quite often the smart money is the money that is making the moves first, and this leads to a disconnect in the stock market that often fuels speculative bubbles. Think about 2019, think about the housing market in 2006 and 2007 prior to the bubble bursting, and then think about what happened, again, with stocks like GameStop. Now, there's a debate as to whether or not the US is different than other countries. Are we actually susceptible to a melt-up? And could it be as bad as places like Venezuela and Zimbabwe? Well, the answer to that is probably not. But it doesn't mean that there isn't cause for concern, and it doesn't mean that the US is immune to a reverse market crash. In fact, in the age of social media, it's my belief that the US is more immune than ever as a direct result of how quickly information flows and how quickly people irrationally jump into and out of markets. Now, there is the argument that the US is a stabilizing force, and the US dollar's reserve currency status helps reduce rapid asset inflation, although this isn't always true. Now, it is true that the US dollar status as a reserve currency provides stability, especially compared to places like Zimbabwe or Venezuela, who were essentially in a place where when their creditors called all of the debt, they weren't able to pay it, which led them to start printing money and obviously devalued their currencies, which led to, well, inflation, and in these cases, hyperinflation, that put a lot of hurt on the people in their countries. Now, the fact that the majority of the world's international debt is held in US currency definitely helps, and it's highly unlikely that another country is going to call in the debt of the US, primarily because the US debt that other countries hold is held in things like bonds and treasuries, which have a finite timeline of when they can be called. These aren't typical loans like you would see a common person get. These are very much bonds that have a finite timeline, and the ability for other countries to call them is pretty much non-existent. Now compare that to Zimbabwe or Venezuela, and of course those were very much loans that could be called by other countries. And that is ultimately what led to the major financial crises in both of those countries. But that being said, that doesn't mean that this isn't a significant issue, and it is a significant issue from the perspective of wealth inequality. And globalization, for the most part, has reshaped labor markets, and this has contributed to inequality. Look at what recently happened with the port strikes in the US, where one of the key negotiating points was around automation of those jobs. And as automation starts to replace jobs, it becomes more and more apparent that people who are on the lower end of the wealth scale are at the most risk, especially during times where asset values are increasing. Because quite often, those people won't be the people that have assets. They will be the people who need to consume and have to consume at higher prices. And if automation is replacing jobs or reducing the wages associated with those jobs, I don't need to tell you that that is going to be problematic. And then on top of that, when we have tax policies that often favor the wealthy, this just deepens the gap even further. But it's important to note that monetary policy isn't the only factor that drives melt-ups. Economics, social, and political factors all play a role, and wealth inequality is a multifaceted issue that during times where asset values are increasing becomes even more of a problem. And this is why it's so important that people make the clear choice to refuse to remain poor. The fundamentals of how to build wealth are available to everyone. The cheat codes are there, the hacks are there, and the opportunity is there if you simply know where to look. But the primary factor that keeps people poor is the acceptance of the fact that that is their fate. But if you're here, if you're watching this, my guess is that you're probably not okay with being on the lower end of the wealth scale, and that you want to know how to insulate yourself from a reverse market crash or from any potential financial issues that could come up in the future. Well, that's the part that comes next. So let's talk about the aftermath of a melt-up, because inevitably after a melt-up, there's almost always a correction. It is almost inevitable as excessive optimism turns to pessimism. Prices almost always return to their fundamental levels, and psychological fear replaces exuberance. In most cases, stock market crashes often follow a melt-up, economic recessions or stagnation may occur, and those who chase inflated prices, like those who are buying gold at the all-time highs or who bought GameStop at all-time highs, are often the ones that suffer the worst losses. Which is why it's so important to be able to recognize a melt-up, whether it's in a single stock, the entire stock market, the housing market, or an economy in general. So let's talk about how to recognize the patterns and how to protect yourself. The first and most important thing that you can do is diversify your portfolio across different asset classes. Never put the majority of your money in one single type of holding, whether that's real estate, gold, stocks, or anything else. It's also important to hold tangible assets, and the most important one is real estate. A place that is yours, that is hopefully as close to debt-free as possible, that nobody can ever take away from you. And you also want to avoid overexposure to speculative markets, things that seem like they are too good to be true. Stocks that have gone up in value almost unexplainably. In fact, Warren Buffett once said it best, never invest in anything that you don't fully understand. And if something seems to be going up in value, but the fundamentals don't make sense, it is best to simply avoid it. Now, if you want to thrive during a reverse market crash, well, there's certain things that you can do. Investing in assets like property and diversified portfolios are the first and foremost. But if you're going to do this, making sure that you do it without over-leveraging, or even having leveraging at all if you can afford it, allows you to buy assets that, yes, are probably going to go up in value, but also allows you to continue to hold them long after they start to come down. And by the way, when they do start to come down, that is your opportunity to buy more and increase your wealth even more dramatically. And what's important is that you watch for interest rate and inflation trends. When interest rates start to go down, that becomes inflationary. And it often leads to people believing that things are going to get better, which spurs inflation. And in the 1980s, for example, every single time there was a slight reduction in interest rates, it almost always led to a further increase in asset values, which ended up causing the Federal Reserve or the Bank of Canada or whichever central bank it was to have to increase interest rates even further than they were previously in order to undo the damage that's done when you lower interest rates. And it's also important that you're prepared. Financial literacy is your most important asset. You need to stay informed about global economic policies. You need to look for signs like rapid inflation or expanding debt or massive increases in stocks and assets that shouldn't be increasing. And you need to build a portfolio, and by the way, this is the most important thing, with inflation-resistant assets. And I'll get to how to do that in just a second. But before I get into that and I talk about the all-weather portfolio, there's some final takeaways and advice here that I need to give you first. The first is that knowledge is the key to navigating melt-ups. And the most important piece of knowledge is that if it seems too good to be true, it probably is. Then you need to focus on being proactive rather than reactive in your investments. This means learning what to invest in, learning how to diversify, and learning how to rebalance your portfolio so that when there's opportunities to buy certain things cheaply, you are buying them. And when things unexplainably go up in value way more than they should, you're taking some of your profits and putting it into the other assets that are typically on fire sale. And then in addition to that, you need to anticipate shifts in the economy for long-term stability. And what I mean by this is really simple. You need to be paying attention to what's going on. And when it looks like maybe there's a recession or there's some sort of financial crisis somewhere down the road, That's not the time to be spending all of your money on the things just because you have it right now. In fact, during the absolute best of times, these are the times where you should be limiting your lifestyle and putting as much money away as possible so you can continue to live a nice lifestyle when things get bad. So let's talk about protecting yourself with an all-weather portfolio. Now, over the last decade, the all-weather portfolio, as suggested by Ray Dalio, hasn't performed as well as some other assets, or as well as it has in the past. But you have to remember that 2020, the pandemic, was a time that was unlike any other. And now that the economy is somewhat returning to normal, well, the all-weather portfolio is starting to make a whole ton of sense once again. And the reason why is because it reduces your risk when certain asset classes are going down in value, while also giving you the opportunity to benefit from increases in other assets that may be going up in value. And this portfolio is quite simply all about owning a broad spectrum of assets so that your risk levels go down to, well, in some cases, almost zero. So let's take a look at the all-weather portfolio. It's typically made up of this sort of asset allocation. 40% long-term bonds, which by the way is the piece that hasn't really performed well in the last couple of years. 30% stocks, 15% intermediate term bonds, 7.5% gold, and 7.5% commodities. Now, the reason why this portfolio works so well over the long term is because typically when stocks are going up in value, bonds are going down in value. And if you are consistently rebalancing, what that means is that as stocks go up in value, you're taking your profits, you're putting it into the bonds that are going down in value, and therefore you are buying the bonds cheaply while you're selling the stocks at a higher price. And what this does is it takes a lot of the guesswork out of when you should be selling, while at the same time making sure that you aren't selling all of an asset that could go up in value over the long term. And then adding in things like gold, which does very well during times where there's lots of fear in the market, and adding in things like commodities, which tend to go up in value during reverse market crashes and melt-ups, because obviously everything is going up in value, or also go up in value when there are construction booms or different types of booms in various industries. Well, having a portfolio like this is essentially the holy grail of de-risking while still making sure that you have the opportunity for high returns. And as far as stock portfolios go, this is the simplest and easiest way to protect yourself from the inevitable, which is the eventual stock market crashes that almost always happen. In fact, if you would have had a portfolio like this during the 2008 financial meltdown, well, you would have lost very little money when in comparison, if you had simply held all of your assets in the S&P 500, you would have lost as much as 50% of your net worth pretty much overnight. And there's some specific ways that an all-weather portfolio protects you. The first is it's designed to perform well in any market condition, boom or bust. Then the balancing of growth assets like stocks with defensive assets like bonds and gold tends to work really, really well over the long term. And it also limits your exposure to extreme market fluctuations and corrections, with the typical drawdown, so in other words, how much money the portfolio comes down when the stock market crashes, is significantly lower than what it would be if you simply held one asset. But the magic of the all-weather portfolio comes from rebalancing. And this is really the key point. Regular rebalancing helps manage risk and maximize returns. It diversifies across asset classes, stocks, bonds, commodities, and real estate on a regular basis, and provides stability in both inflationary and deflationary environments. So in other words, you don't just create an all-weather portfolio once and then let it ride. The goal is to always have the asset allocation remain the same. So if stocks go up to 35 or 40% of the value of the portfolio, you simply sell off the top and you reallocate so that your asset allocation is always the same. And the reason why this is so important is because that asset allocation is designed to reduce risk. And by reallocating, what you're actually doing is you're maintaining your target risk levels, which in an ideal world, the risk level is almost zero. And then you're also preventing yourself from overexposure to inflated assets during a melt-up. So if stocks start going through the roof, it's time to start taking some of your profits so that when they do change in value, when they do crash, and when they do come down in value, you aren't overexposed to them having a significant amount of your portfolio in that overheated asset. And then last but not least, if you do this right, it improves long-term performance in your portfolio by taking advantage of market corrections. Yes, that's right. With the all-weather portfolio, a market correction is actually your opportunity. And like I always say, from every crisis comes opportunity. And if you have this set up properly and you have very minimal debt, you have a house that's as close to paid off as possible, and you have the right asset allocation, a market correction is in fact a benefit instead of what it will be to most, which is a potentially catastrophic financial event. So with interest rates coming down, there's no doubt that there's the potential for a reverse market crash or a melt up. It's just going to happen. People are going to get overconfident, asset values are going to start to go up, and things are going to get more expensive once again. Now, hopefully this ends up being a soft landing, but in the event that it's not, it's important that you act now so that you're prepared just in case. Because there's one thing that's almost always true about good times. They eventually come to an end and bad times are around the corner. But if you're prepared, you'll know exactly what to do and you'll know how to take advantage. And by the way, the last couple of years have been really good, all things considered, which means at some point, sometime in the future, there is going to be a recession. And the question is when and how. And if you want to know what always happens before a recession, make sure you check out this video right here.